There's three key ingredients here that make this happen. So the first is at-scale audiences. This gives niche creators an incentive to create content to attract attention from consumers on the social platform. Welcome to Affiliate Marketing for Lenders. I'm your host, Carlos Caro. Banks spend billions of dollars per year advertising in affiliate channels. It's a complex, high-stakes game, and I'm here to guide you through it. If you're a lender that wants to grow your affiliate program, you're in the right place. Let's dig in. All right, so I've realized, kind of going back through some of the older episodes, that there's a theme here around affiliate marketing that I think is actually super important, and I don't think I've hit it sufficiently or strongly enough so far. So today's the day we're going to go there. We're going to talk about personalization. And the whole personalization thing is obvious to any direct marketer that, works in particularly direct mail is where I see it most often. But the idea being, if you want to optimize for response rate, then you need to be real careful and thoughtful and granular around matching specific consumer segments to products. It's not an innovative idea. Direct marketers have probably been doing this for centuries. So going back to something we talked about in the first episode, which is building the best funnels and the most kind of highly converting funnels, personalization plays a big role here. So if you're a credit card issuer, you should probably be thinking about optimizing annual fees or reward structures or sign-on bonuses and personalizing them to specific customer segments. Now, the way you do this in an affiliate channel is going to be highly dependent on the kind of targeting capabilities the affiliate has. So once you're up and running and you've found a true baseline, you've kind of hit the low-hanging fruit opportunities, personalization is going to be something you're going to want to raise to your partnerships team. And one of the first questions you'll ask is, what data do you have on your end to help me personalize my offers? The affiliate's going to know when you ask that question that you're contemplating bringing more than one flavor of any particular card, or maybe just bringing a whole suite of products that speak to different users in different ways. And they should be excited about that, because that should increase CTR and ultimately the pull through in their conversion funnel for each of those products, assuming the matching's done well. And ideally, you've tested this or have some idea of that product mapping, that product to segment mapping from other channels that you've worked on. And if you don't, you may want to ask your affiliate partners if they have a way to help you test that. That's the basic idea. I think it's probably most applicable in credit cards, given those products have the most number of different dimensions to them. Products like personal loans, auto refi loans, yes, there's some dimension to personalizing rates and loan amounts, that sort of thing. But I think it's just a much richer conversation and topic for credit cards specifically. So that's that. I would have felt remiss to not hit on personalization. I do think it's probably a tier 2 or tier 3 opportunity for most issuers that are new to this game. There's going to be, bigger fish to fry, so to speak. Things like improving your application funnel, making sure your approval rate's really high, for reasons we've discussed in prior episodes. So I want to take today's episode in kind of another direction here. And what I want to start getting you to think about is, what would it look like if I started building hyper niche lending products? So again, taking the idea of personalization to the nth degree. And the concept here isn't, what if I built 2 or 3 or 4 or 5 different flavors of my card to kind of better appeal to segments. The idea here is like, what if I went really crazy? What if I built products for 100 different segments or 1,000 different segments? What would that look like? What benefit would it bring to me as the lender? What supports doing that a good idea as far as what's going on in the affiliate ecosystem? So I'm going to talk about that. I'm going to link to an article I wrote on this. I called it The Case for Building Hyper Niche Lending Products. I published this on October 24th, but it's linked down in the show notes if you prefer to read. You can stop here and go there. Otherwise, I'll talk you through it. Okay, so here's the TLDR on it. Personal finance platforms like Credit Karma, for example, are now at scale, and they have the ability to recommend products at the one-to-one level. And furthermore, they're incentivized to recommend these types of products that are highly customized to each user. But lending products, for the most part, are designed for mass audiences, and it's this disconnect that presents a huge opportunity for lenders. So let me give you some backdrop here. I'll talk about social channels for a second and how they match content to users. So let's take me for an example as a content creator. I write about a topic that 99.999% of people don't care about, and that's affiliate marketing for lenders. And yet, I find it worth my time to maintain an active LinkedIn feed, this podcast, and a newsletter. And that small amount of attention is powering relationships, networking, ultimately business for my consultancy agency business. And my business helps lenders build affiliate programs. It's called New Market Growth. So Gary Vaynerchuk described what's happening on LinkedIn as the TikTokification of social media. That is really hard to say, but it encapsulates the idea really well. Platforms like TikTok, Facebook, Instagram, LinkedIn, and others have figured out how to distribute content based on what people care about, not based on who they follow. So that means it's game on for niche creators. Anyone with niche content that helps a small audience can now build free distribution for their products and services. The social media networks love it because now they can serve highly relevant content for every person in their network, no matter how eclectic or rare their interests. That keeps eyeballs on their platforms, and that keeps advertiser marketing dollars rolling in. There's 3 key ingredients here that make this happen. So the first is at scale audiences. This gives niche creators an incentive to create content to attract attention from consumers on the social platform. 2 is you need to have niche creators at scale. Lots of niche creators covering lots of different surface area. Without them, the platforms wouldn't have content that's hyper relevant to each user. Without this niche content, platforms like LinkedIn would feel like CNBC plus resumes and messaging. By that, I mean the content would just be highly generic, something you would find on kind of a mass media publisher. And then third, matching algorithms. Without the sophistication in matching between audiences and content, usually we're talking about machine learning, AI, audiences wouldn't get the most useful content and creators wouldn't get their content in front of their ICPs, their ideal customer profiles. Both sides would eventually give up. So what is the upshot of all of this? I think a 2024 creator on LinkedIn with no resources, no connection, no history of success can get a content piece in front of a billionaire angel investor who may decide to put, let's say, $50 million into their next venture. And that nobody creator might get more attention from VCs than entrepreneurs with much deeper pockets and traditional media connections. That nobody creator didn't have much of a chance against the deep-pocketed, well-connected entrepreneur even 15 years ago. Social media is a playing field leveler, and the best content will win, period. So the stage is set for hyper niche financial services products. The same thing's about to happen in financial services, but most don't know it yet. So let's look at a platform like Credit Karma. They have 130 million plus members, and they understand their users deeply. Supriya Gupta, VP and GM of product at Credit Karma, describes how Karma's data is powering personalized recommendations for financial products in a recent interview with the AI in Business podcast. She says, and I quote, "We've built on that trust through the years with not just credit scores, but also information about your car, your home, etc." The quote goes on. But going beyond recommendations, Karma's looking to automate personal finance decisions based on what they know. Gupta described it as, and I quote, "Autonomous finance is about figuring out what's best for you with the least amount of work possible," end quote. So earlier we described the 3 ingredients niche content needs to thrive on a platform: large audiences, niche creators at scale, and matching algorithms that can connect users to the most relevant content. I think Credit Karma has 2 of those 3 ingredients in place right now: the at-scale audiences and the matching algorithms. But it's missing the niche creators at scale, in my opinion. You know that's true simply by looking at their product inventory. 331 cards listed publicly on Credit Karma's site. I'll link to the article, which links to the source of that. Those 331 cards need to serve all 130 million plus users on Karma's platform. The scale of Karma's data and supply of cards means their product matches are probably industry leading, but it's hard to consider them super personalized. Here's how to see it. If we divided the 130 million members by 331, the number of credit card product options available there, we get about 393,000. That means for each product on the platform, on average, there's a group of 393,000 members for which that product is the best match for their needs. And since many of these products are very similar, a lot of them look like 1.5% cashback type products, the recommendations are less personalized than these numbers suggest. Lenders build generic products intended to serve large swaths of consumers. These products were designed decades before at-scale platforms that can make one-to-one recommendations like Credit Karma existed. And because they had to distribute their products in mass media channels without granular segmentation, product design was generic for broad appeal. Example, again, that 1.5% cashback product on all categories. But that's starting to change. So now we're seeing cards for teenagers and kids, Greenlight. For homeowners, a product like Avon. For car owners, a product like Yendo. For international students, a product like Zolve. Fintech players are moving the ball forward. But I don't see enough lenders serving the hyper niches in the same way content creators serve hyper niches on LinkedIn. Where are the creators creating the card for the single mom with 2 kids under 7? How about the card for the retired couple living on Social Security who travel to visit their grandchildren? The number of possible niche segments and products is staggering. And as ecosystems like Credit Karma evolve, it makes sense that the niche products will not only compete with the mass appeal cards, they'll actually win the consumer's attention in many cases. So, when 10,000 plus niche products are available on Credit Karma, how often do you think Karma is going to recommend that plain vanilla 1.5% cashback card? I think Karma is bound to find a more relevant, more personalized option for each user, and that is likely to increase the odds of conversion, which drive revenue growth for their business. The platforms that nail relevance are going to win, and the platforms with the most variety of products to choose from will stack the deck in their favor. So I want to add a little context here from something I read years ago. We're still in the early days of what Frank Rotman calls the Copernican revolution. So why build hyper niche lending products? Because you're going to be betting that mega platforms like Credit Karma will figure out how to connect hyper niche products with consumers, making them commercially viable when previously distribution would have been too costly. Furthermore, you're betting that over time, the majority of product distribution from mega platforms will migrate towards hyper niche offerings, because they stand to drive better conversion rates. Here we get to Frank's paper. It's called The Copernican Revolution in Banking. Frank Rotman made the following observation, and I quote, "Share will increasingly become concentrated in the hands of the best-in-class product providers as channel barriers fall and information becomes more abundant." Rotman predicted 4 types of players would emerge from this trend. Bullets below are directly for his paper, and I'm going to quote the 4. Group 1, transactional banks that manufacture white label versions of specific products and services. 2, Gen Pop banks that serve the general population with a broad suite of products. 3, vertical banks that serve specific segments, not the general population. And then 4, non-bank players will be able to distribute banking products manufactured by the transactional banks. So using Rotman's language, the big banks are the Gen Pops. Some fintechs are starting to occupy the space he calls vertical banks. And Credit Karma is one of the largest non-bank players that can distribute products to a massive base of engaged consumers. To emphasize the point I'm making in this article, the hyper niche products will grow and disrupt many Gen Pop banks. Rotman puts it this way, and I quote, "Vertical banks will be very disruptive to the banking ecosystem. They will dominate a segment by offering a small number of world-class products that are hyper-focused on the segment's needs." So here are my closing thoughts. I think the TLDR is this. we have platforms like Credit Karma with massive audiences, granular data on their personal finances, and the strategic imperative to build personalized one-to-one recommendations for their users. Platforms like these present an opportunity for niche lenders to distribute products efficiently, enabling the disruption Rotman predicts in his Copernican Revolution paper. Despite the opportunity, we don't observe this happening yet. Credit Karma's credit card marketplace has 331 products to serve 130 million plus members, and many of those products have similar value propositions for mass audiences. Lenders, there's a huge opportunity to build niche products that modern non-bank players like Credit Karma can distribute. In the next 10 years, I expect we're going to see marketplaces like Credit Karma significantly expand their product catalogs as fintech players start to act on this opportunity. So the stage is set for lenders to distribute hyper niche products efficiently. The next question, will lenders be able to create and manage these products with unit economics, cost structures that make sense? When the opportunity is this large, it's only a matter of time before someone figures it out. And if you're a hyper niche product fintech lender and you're not sure how to approach your marketing or distribution strategy, let's chat. This is something I've been thinking about lately. So that wraps today's podcast. If you enjoyed the show, the most direct way you can support the podcast, if you're a lender, is by checking out New Market Growth. We're at newmarketgrowth.com, and check out our services. The other ways to support the show are simply by sharing what you heard today with a colleague on social media or with a friend. Thanks for spending the time with me here today, and I'll see you soon.